Over the last few years, I noticed that some of the new accountants entering the field are confused between two concepts. One is accounts payable and the other is accrued expenses. So I decided to make this video to eliminate confusion once and for all. So in this video, we're going to be discussing accounts payable versus accrued expenses, and we're going to be talking about how to locate them on the financial statements and how to go ahead and record them. And you're going to want to stick around till the end because I'm going to show you examples with real numbers on how to record accrued expenses. But before we continue, as you're watching this video, if the material is helpful, go ahead and hit the like button because that helps my channel reach more viewers. And if you're new here, welcome. My name is Bill Hanna. I'm the financial controller. I'm a licensed CPA in New York, and I work as a controller at a software company in New York City. And I'm the founder of this channel, as well as the Controller Academy, which is an online course that gives you all of my experience over the last 18 years working in accounting to prepare you in becoming a corporate controller yourself. So let's go ahead and dive right in. So we begin with accounts payable. Accounts payable are amounts recorded from vendor invoices for goods and services. So you go ahead as a company and you buy goods and services to run the business, and you receive a vendor invoice. You go ahead and record that as an accounts payable because you're going to go ahead and pay it within, let's say, 15 days, 30 days, depending on the terms that the vendor is providing you. Now, with accrued expenses, on the other hand, these are obligations to pay in the near future. And the word accrue just means to accumulate. So it means accumulate or increase, right? So accounts payable is very simple. You have a vendor in hand and it's been approved and you go ahead and record it. With accrued expenses, these are obligations to pay in the near future, and you're going to go ahead and record them to comply with US GAAP. So US GAAP requires you to do accrual accounting versus cash accounting. And I have a video that discusses the difference between accrual accounting and cash accounting. I'll leave a link up here. Basically, cash accounting is not compliant with US GAAP, right? Do not use cash accounting whatsoever unless you're a tiny business. If you're a small business making under $1 million in revenue a year, go ahead and use it because it's easier, right? For expediency and ease, you can use cash accounting. However, once you exceed $1 million, typically a year in revenue, you might want to look into accrual accounting because that's what's accepted by US GAAP and also what's accepted by investors who will look into your business to invest in it. So accrued expenses, these are the obligations to pay in the near future. Also, another way to phrase accrued expenses is accrued liabilities. This is the same thing. So we're talking accrued expenses, accrued liabilities, same exact thing. Okay, now where to locate on the financial statements? Well, when we look at the income statement, the various elements, we got revenue, cost of sales, operating expenses, non-operating expenses. The way that the financials are being populated is that revenue gets populated from billing and revenue adjustments at month end, right? And then the various elements of the business are going to be accounts payable, payroll, employee expenses, and then expense accrual or accrued expenses, which is the second topic we're talking about today, right? And this is what makes up the other elements on the income statement, which are cost of sales, operating expenses, and non-operating expenses. So to locate this on the income statement, accounts payable is here, is what populates all of these various items on the income statement, and expense accrual is the adjustment that we make at month end to accrue for expenses for which we don't have an invoice yet. That's as far as the income statement. Now, when we look at the balance sheet, we'll see that both of them are going to be under current liabilities. Now, there are some cases where accrued expenses are long-term liabilities, but for the most part, 99% of the cases, the obligations are going to be near-term, payable within 12 months, and therefore are going to be under current liabilities. But also know that in some cases, if these obligations for under accrued expenses are payable beyond 1 year, they become long-term liabilities rather than current liabilities. Okay, let's take a look on how to record these transactions. So let's first take a look at accounts payable. We have here the cycle that we refer to as procure to pay, and accounts payable is going to be sitting at the end of that cycle. So from the point in time where you take possession of the goods or you receive the service and you get an invoice and you make a payment, this is called accounts payable, and it's part of the larger process of procure to pay. And this entire cycle and process is described in detail in my Controller Academy online course, which there is an entire module dedicated to procure to pay and accounts payable. So go ahead and check it out. I'm going to leave a link down below. Okay, so let's take a look at an example of an invoice for accounts payable and how we go ahead and record it in the accounting software. So here we have an invoice from 123 Dig Marketing Inc. and it's for monthly PR or public relations services, 12 months, March 2022 to February 2023, and is for $12,000 with sales tax is $12,960. Let's go ahead and record it in the accounting software. All right, so I'm logged in QuickBooks Online, and I'm gonna go ahead and create this invoice in the system to populate accounts payable. So I'm gonna click on New. Under Vendors, I have Bill, so I'm gonna click on Bill, and I'm gonna select the vendor. So we said that the vendor is 123 Dig Marketing, so I'm gonna start typing that. If the vendor already exists on my record, it's gonna show up here. So I'm gonna select it, right? It has the address. The payment terms are already populated in my system. I'm gonna go ahead and put the bill number in here, invoice number 134. And then I scroll down to category and select prepaid expenses because this looks like it's an entire year of service. And then write my description here, PR services, and then put in the amount, put in the class. This is how I'm tracking my expenses, whether it's a cost of sale, G&A, which is general and administrative, research and development, sales and marketing. This one is a marketing service, so I'm going to click sales and marketing, and now I'm ready to go ahead and save it. Now the next step in this chain is to go ahead and make payment on this invoice, which will complete the cycle of procure to pay and accounts payable. Okay, now let's shift gears and talk about accrued expenses. So accrued expenses is a part of month-end close procedure, right? So if we're looking at a calendar for November of 2023, we are closing the month of October, and we'll close accounts payable on day 4, and then we'll go ahead and accrue for expenses on the next day, right? So I'll show you here an example of a month-end close checklist. So I'm gonna switch to that here. So this is my month-end close checklist. And if you'd like to download this file here, I'm gonna leave a link down below to download this checklist. So I have here a close AP. So, and on day 4, I have close AP after all approved vendor bills have been entered, right? And then the next day I have accrue vendor invoices and other accruals, plus my payroll accrual here, which is a vacation accrual. So this is a good helpful list to keep track of all of my month-end close tasks that I have to do to close the financial period. So this is the monthly close calendar. Now let's take a look at the different types of accruals that I consider at the end of each financial period. So the first one is going to be for vendor invoices received but not approved. So at the end of each period, I have a bunch of invoices, maybe 10 to 20 invoices that are received from vendors, but I'm still chasing a purchase order or maybe chasing an approval from a manager. So I can't post in the system yet. These need to be accrued in the systems to account for the expense while closing the months. The second one is going to be vendor invoices not received, right? But the service have been rendered. So the concept with accrual accounting, if the service have been rendered, now you incurred the cost and you need to accrue for it, right? Even though you haven't received the invoice yet. Or if the goods have been delivered. So if it's an actual physical product and you've received it and the terms with the vendor state that the title will transfer upon delivery, let's say, then that means that you've already acquired ownership of this physical good and you need to accrue for the invoice in this case. And the third most common type is going to be compensation accruals. So these are payroll, vacation, bonus accruals, all of which I cover in my online course, The Controller Academy. But basically for payroll, if you're paying on an irregular, let's say every 2 weeks, and you have a gap between the 28th of the month and the end of the month, those 2 or 3 days you need to accrue for the salary. For example, vacation, you have a liability as an employer to pay out vacation, then you have to accrue for a vacation liability. Same thing for bonus as well. So let's take a look at an example accrual, and the one I want to use here is vacation accrual. So we're going to go ahead and use real life numbers to accrue for vacation on the books and records. Right. So vacation, just to give you a background, when you give your company the choice or the ability to take vacation days, you can potentially create a liability for the company by doing so. And let's look at a couple of examples to show you what I'm talking about. But generally, you have to record a vacation expense and a related liability. Because remember, the company has to pay for your unused vacation balance if you quit. So if you resign the company and you have a vacation balance, the company is obligated to pay you that vacation balance in cash, right? So that's why a liability might come up. So the couple of different situations you might find is that if the company offers unlimited vacation days, and this is currently the situation with many companies now. The new style is to give you unlimited vacation days, which also known as no vacation days, right? Like they usually grant you unlimited vacation, and what ends up happening is that people take no vacation. But that's not the point here. The point is that the company is giving you unlimited vacation days, but at the same time, the company is not assuming any liability to pay you this vacation balance because it's unlimited. Therefore, there is no balance if you leave the company to pay you, right? In this case, no accrual is necessary, right? But the other situation you might find is that the company offers, for example, 20 days of personal time off, PTO, per year, right? 20 days vacation days. This means that there's a liability to pay an employee if they resign the company, right? So if you give me 20 days as an employee and I use only 5 or 6 days throughout the year and I quit, then all of a sudden there's maybe 14 days or 15 days remaining as a balance that you have to pay me in cash. Right, so therefore you have to record the liability and an accrual is needed. So this is the case here with Spot Booker. We have a certain number of days per year, 20 days per year, and we need to go ahead and create an accrual for vacation liability. So let's go ahead and look at an example of how I calculate and record my vacation liability. All right, so this is my vacation liability accrual Excel file. I'm gonna go ahead and attach this to the lecture so you can download it and take a look how it's set up. But basically what I'm doing is I'm downloading a report from my payroll provider that shows me my outstanding vacation balance as of a certain date. So I'm downloading as of Jan 31st, 2022 as a starting point. And then I'm creating at the bottom here 3 tabs, one for Jan, one for Feb, and one for March, so I can track the vacation balance, how it changes each month. So let's take a look how it's set up for January. So for example, the way it's set up is that my report will have my employee number, employee name, department. The department is just going to be important in terms of booking the journal entry by department. So if you are tracking expenses by department, this is always recommended that you track it this way so that you can generate financials by department and figure out how much each department is costing you in expenses. So I have here some information like hire date, last payroll date, annual salary, vacation balance in terms of hours, and this is a key column here. I'm going to highlight that maybe in yellow because that's an important column, right? Vacation balance in hours, and then the hourly rate, and then the vacation balance is a calculation that I make. So for example, if you take the first employee, John Lee, right? He's got 12 hours left as a vacation balance as of Jan 31st, 2022. His hourly rate is $96 per hour, and I determined that by taking his salary of $200K, dividing it by 52 weeks in the year, and then dividing by 40, right? That's how I determine his hourly rate, right? 40 because 40 hours in a week. And then I multiply the number of hours of vacation balance by his hourly rate, and I say, okay, for this guy here, I have a vacation balance of $1,153. And that means that for this employee here, if he resigns the company, for example, the following day, like on Feb 1st, I will have to pay him this in cash, $1,153, right? So I do this here, and then I summarize it at the bottom, and I say the total is $98,000. And then I summarize that here in a table by department by using a SUMIF formula. And if you're not familiar with SUMIF formula, you can just easily go on YouTube it, SUMIF formula in Excel, and see how it's done. It's pretty simple. You SUMIF by department, right? And then your journal entry is going to be as follows. Your journal entry is going to be to debit vacation expense and credit vacation liability. And an expense here is that you are recognizing you have an expense in January, 98,000 that you're granting in vacation. And then your liability is saying that, hey, I'm exposed to $98,000 in liability if my employees were to resign the next day, right? This is the theory. And then if someone is terminated after that, and you need to make an adjustment for their termination, say one employee has a balance of 4,500 unused, right? What you do is you don't record the new expense because remember, you already recorded the expense, right? But what you do is instead of debiting an expense, you debit vacation liability, right? To reduce the liability, you're saying I'm reducing my liability by this much because I'm paying this guy for his balance and credit to cash. So this is what I do in January, right? And then every month, so I'm gonna go ahead and record this in QuickBooks. And then every month after that, I have to make a true up. So for example, when we look at February 28th, 2022, I'm gonna run that same report from TriNet, right? And come up with my vacation balance, which now went up to 110K, right? And then I'm gonna summarize that by department. But notice here that I'm taking the difference, only the difference between February and January. So I am saying here that the balance for sales and marketing went up from 28,000 in January to 32,000 in February. So the difference is 3,800. I'm only going to record that difference, which is in total $12,000, $12,100, right? I'm not going to record the entire amount again because I've already recorded the 98,000 in January. I'm only recording the difference, right? And I'll do the same thing in the month after that. So basically you keep a running list, each tab representing 1 month, and then basically every month you got to capture the difference in the total balances from the current months compared to the prior months and book that difference. So in the accounting software, let's go ahead and take a look at an example how this journal entry for $4,800 will look like as a journal entry. So in QuickBooks Online, you will be booking a journal entry as of month end, March 31st, 2022. And it will be made up of 5 line items because you will have your vacation expense 4 debits by department. Each department is represented here: sales and marketing, G&A, R&D, cost of sales. And that's the same thing that we've seen in the Excel file. So if you look at the Excel file, we have here sales and marketing 1,500, and each department has an amount adding up to 4,800. And that's the total here. So it's going to be 4 debit line items to expense and a credit to liability, accrued vacation liability for 4,800. And that's how it looks like. If you look at how it looks like on the balance sheet. So on the balance sheet, let's generate that. So on the balance sheet as of March 31, 2022, you'll see here that we have under liabilities, we'll have accrued vacation liability 115,000. Remember that number, 115,000, which is the balance as of March 31 based on this support here. So this is just a quick overview of how to think about and record accrued vacation liability. Go ahead and download this file in Excel. I'm going to leave it attached to the lecture, and you can go ahead and play with it. I also want to hear from you in the comment section below which concept in accrual confuses you the most, right? So let me know down below. That could be good for a next video idea. So let me know in the comment section.